This Wednesday sees a likely rate cut from the Federal Reserve, and it's been a long time coming. Donald Trump's been trying to push Jay Powell out of the Federal Reserve, all in the aim of trying to see lower rates sooner. Well, he's had to wait, and ultimately it looks like the time has come. Whether we see a 25 basis point cut, a 50 basis point cut, whether they laid the foundations for interest rate cuts in the following meetings, and what the implications could be for the US dollar, for gold, for US stocks. Let's cover all of that and more in today's video as a preview for Wednesday's FOMC announcement. So essentially, when you're looking at the Federal Reserve, the two main things they have to keep control of is inflation. They want to keep that down or around the 2% target, and unemployment. They want to make sure that unemployment does not rise. Now, we have the sort of so-called dual mandate highlighted here, and we can see that we have seen inflation ticking up a little bit of late, but not massively. That's according to the Fed's favored core PCE price index metric. So still within the twos. And then on the unemployment front, we've seen that moving upwards, but not drastically so. So what really sort of wins out on this occasion? It's notable, of course, that the likes of Jay Powell and many of the members within the FOMC have been fearful around what tariffs might mean to inflation levels. And that essentially has tied their hands, because as long as there's huge uncertainty around exactly what could happen around the corner on the inflation front, then you don't necessarily just trust recent data. You're constantly thinking, well, the next one's going to show a resurgence in terms of inflation pressure. So that's part of the reason why the Federal Reserve have been holding off. And in the absence of a major deterioration in terms of the jobs market, it provides them with the opportunity to be more patient in their approach. That has been the case for much of the time since Donald Trump came into power in April. Things have changed recently, and that's why we're now essentially, according to markets, 100% nailed on for a rate cut this Wednesday. And so let's cover the two sides of it. First and foremost, the inflation side. If you look at three of the sort of main metrics we can see here, CPI, core CPI, and core PCE, what's notable for all of three of them is that they have all moved higher more recently, but not drastically so. This doesn't look like a chart that is screaming for the Federal Reserve to pay attention to it. So as things stand, inflation pressures have built a bit, but not necessarily to the extent where many had feared, and that does afford them the opportunity to potentially cut if they deem it necessary. But that's the annual metric, and certainly anyone that watches my videos will know that I sort of comment on the so-called base effects quite a lot, because what happens on a year-on-year figure may not be representative of what's happening over the near term. So how's inflation been playing out? Well, not ideally, quite frankly. The latest inflation metrics we've seen in terms of CPI and core CPI have both moved higher than the previous month. Notably, it was 0.4 for the headline number in terms of the monthly figure, 0.3 for the core number. But as you can see here, the 0.4 was a little bit below 0.4 and the 0.3 was a bit above the 0.3. So both of them higher than the previous month, and that seem to be sort of a continuation of the upward trajectory seen over recent months. Now, you can also see here that the core PCE has been on the rise. We haven't seen the August figure yet, but the numbers we've seen for CPI do point towards that monthly figure being higher than the previous one. So it does look like inflation pressures are building. Now, this is a way of looking at it by segmenting different elements of that inflation metric. So you can look at inflation as a whole, or you can just say, okay, well, what's the services sector look like if I took shelter out? Bear in mind, shelter is roughly a third of the inflation metric. What does shelter look like by itself? Because that's going to be a major driver of inflation direction. What does core look like without shelter? And then we've got the core PCE and the CPI and the core CPI. And I've put them all on 3-month annualized. And what we do by putting it on a 3-month annualized view, that essentially says the last 3 months, what's the pace that they're moving at? So you might say, I've been driving at an average of 60 miles an hour or kilometers an hour on a motorway. That doesn't necessarily explain the fact that you might have been driving very slowly for a period of time, and then at the back end of that, you know, if you were taking like a 10-minute view, you could be driving very slowly at the beginning, then you're going 100 miles an hour for the most recent few minutes, right? So I want to see exactly what the more recent inflation trajectory has been like, because I don't care that much about what happened a year ago, but I do care a lot about what's happening more recently. So the last 3 months, how is that building? And if that was turned into an annual figure, what would that look like? Well, we can see that here. And so many of these metrics more recently have really started to pick up in a meaningful manner. You can see here core, excluding shelter, up to almost 4% on an annualized basis. You can see that blue line as well, CPI, on the last 3 months. Annualized, that's been moving significantly higher. And that comes despite the fact that energy prices, of course, have been relatively depressed over recent times. Picking up a little bit, but still, there's a question mark of how this would look if it did pick up in a very meaningful manner. Shelter ticking up a little bit this time around, but I would say the overall trajectory for shelter is actually supportive for lower inflation rates. But certainly from this view, it highlights part of what we've seen on the previous chart. And that is that in my mind, inflation pressures have been moving upwards. The question for many is whether the Federal Reserve should, not necessarily should care, but should pay enough attention to hold off on cutting interest rates, because they essentially need to make sure that they're addressing both sides of it. Now, if we're looking at the inflation side of it, it's been moving higher, but not aggressively so. And we have heard from many members in the past saying that they would be willing to look beyond policy-fueled short-term inflation, knowing that it's a one-off, right? This isn't ingrained inflation. This is a one-off response to tariffs from Donald Trump to an extent. So you have that on the inflation side of things, rising, but maybe not to the extent that it ties the hands of the Federal Reserve. Then on the other side, you have the labor market. And of course, we've seen significant weakness in terms of the payrolls. Recently, we've seen the beige book out of the Federal Reserve. And I thought this was interesting because we don't necessarily know exactly what is making the numbers sort of weaken. It could be businesses being fearful because they have great uncertainty around policy under Trump. It could be businesses suddenly seeing significant rises in terms of costs of goods coming in. So it means their margins are weaker, so they have to lay off workers. It could be that people aren't hiring to the same degree because we're seeing this clampdown on immigration. And so there's less workers out there to be able to hire. So maybe they want to hire, but they're not able to find the right person. It could be that there's AI on board now, and we don't necessarily need as many humans. We can just get the robots to do the work for them. We don't necessarily know what's making these numbers super weak and what's making them sort of hold up well. So if you look at this breakdown, I thought it was really interesting. So just to read it out to you, 11 districts, these are sort of Federal Reserve districts, 11 districts described little or no change in overall employment levels, so not a significant uptick in employment, while and that is in line with the fact that payrolls are like just diminishing to near enough nothing. While one district described a modest decline, 7 noted that firms were hesitant to hire workers because of the weaker demand or uncertainty. So that's not good news. Moreover, contacts in 2 districts report an increase in layoffs, while contacts in multiple districts reported reducing headcounts through attrition, encouraged at times by return to office policies and facilitated at times by greater automation and new AI tools. So ahead nod to that direction. In turn, most districts mentioned an increase in the number of people looking for jobs. However, half of them noted that contacts reported a reduction in the availability of immigrant labor. Again, a nod to that direction. New York, Richmond, St. Louis, and San Fran highlighting its impact on the construction industry in particular. Half of them described modest growth in wages. The others reported modest growth. So ultimately, you're seeing a little bit of all of that, quite frankly, but certainly weakness across many of these different districts in the US. And that's reflecting in a number of different jobs metrics. So the most important and the one that's really grabbed the market's attention has been the payrolls, right? It continues to weaken. And the one you want to look at here is the orange line at the top. That's payrolls, but once you've seen the revision lower. So a lot of the time, the initial payrolls one, the figure, the one that we all pay attention to when it first comes out and the market moves to, that has actually been overestimating for the most part. And you can see on the bottom the difference between the initial and the final readings for pretty much the entirety of 2025. It's been overestimating on the initial, and then it's been revised down time and time again. And those revisions have been getting bigger and bigger, right? So the figures don't look great in the first place, but they get worse in a month's time once they get revised lower. We've just seen 911,000 a revision of 911,000 jobs lower after the latest annual revision the other day. So really, from a payrolls perspective, things definitely don't look like they're in particularly good shape. Now, this is payrolls by sector, right? But I've also taken out the one sector that made it look half decent. And the reason for that is essentially, if you're looking at each of these colors, right, it represents a different sector. And the orange line represents where the payrolls have come in. Now, if I remove the education and healthcare sector, that essentially was the only one that really looked healthy over recent times. And the rest of them are either sort of marginally higher or essentially negative, right? There's more negative sectors in terms of payrolls growth over the last release. Then there are positive ones, especially when you factor in the removal of education and healthcare. So education and healthcare has been propping it up. And ultimately, if we had a healthy economy, all of these sectors, or the vast majority of these sectors, would see increased hiring. And so just having one sector that's maybe propping things up, and without that you're seeing negative jobs growth, that's not a great position to be in. And that does point towards the need for the Federal Reserve to step in, which is why, in no small part, that's why they're having to do so. Now, there's other metrics to look out for, of course, and last week we did see the jobless claims figure rise to a 4-year high. That came out at the same time as the inflation metric. So remember, we looked at that previous chart and the monthly inflation figures are going up and up and up. The most recent headline inflation figure was 0.4%. Well, that came out, and at exactly the same time we saw the jobless claims figure, which comes out every week. It doesn't always grab our attention particularly. Where you can see here, the orange line on the top section of this chart, that's the initial jobless claims with a spike up to a 4-year high. The continuing claims continue to climb, but it's a gradual move. But markets really sort of jumped on that and said, okay, fine, inflation's rising a little bit, but ultimately we're seeing initial jobless claims spiking here. And that's telling another story about distress within the jobs market in the US. Now, the bottom section, we've got JOLTS job openings, which continue to decline. I wouldn't necessarily worry as much about that. They're kind of at the levels we were pre-pandemic. So they're kind of, I would say it's a normalization. But then we've also started to see the unemployment rate rising. It ticked up this time around. The caveat to that is, from a historical standpoint, it's not too bad. And also, if you compare to many other countries around the world, it's still very low. I think it's 4.3, 4.4. So I wouldn't necessarily say unemployment is like massively surging. And remember that sort of dual mandate image we were talking about. Look, inflation isn't really moving up much and unemployment isn't really moving up much. However, we're now talking about the idea that inflation is a problem because the latest monthly figure is higher, and more recently it's been climbing higher and higher on a monthly basis. So inflation is a problem, despite that first image I showed you. And then unemployment isn't moving upwards in a sort of dramatic fashion. But then when we look at the payrolls, we look at the jobless claims and the like, then the jobs market is a problem. So we're sort of looking into different elements of the inflation sort of picture and looking into different elements of the jobs market to see whether there's problems. And certainly there are problems under the bonnet. I would say that when we're looking at the sort of fallout from last week's inflation data and comparing it to the sort of before that. So, like I said, spike in terms of jobless claims, rise in terms of the monthly inflation figures. What came out from that? Markets remain convinced we're going to see a rate cut this time around. But the difference is that we've seen a sort of fading in terms of expectations for a 50 basis point cut. That oversized cut is just something that markets are now thinking probably won't happen because inflation is sort of rearing its head to a small degree. Now, I'm just going to quickly try and look up exactly the quote. I saw a quote earlier. Here we go. So, Donald Trump predicts big cut, in his words, big cut from the Federal Reserve. Markets predict 25 basis points. Does he know something that we don't know? very unlikely. I mean, look, the meeting hasn't got underway. It's a case of them voting to see exactly what they think is the right course of action. And just because Donald Trump says on the Monday that he wants a big cut, that doesn't necessarily mean that everyone's going to vote along the lines of a 50 basis point cut. And markets certainly aren't pricing things in that direction. You can see that exactly here. This is according to the CME. Markets 94.4% chance of a 25 basis point cut. This is across the top line here. That's the September meeting. 5.6% chance that we see a 50 basis point cut. So it's pretty much nailed on, right? Markets expect widely a 25 basis point cut. From there on in, we've got an 85% chance that we're then at least 25 basis points lower by the October meeting. And then by December, 80% chance that we see another cut then. So markets are now very convinced that we're going to see a rate cut at each of the 3 remaining meetings of this year. And then if you look into next year, it's roughly sort of a rate cut every other meeting. And then things even slow down a little bit more towards the back end of the year. So sort of ramping up the rate cuts now is the feeling. And that, of course, has implications in terms of sort of market sentiment. If we're looking in terms of recent shifts in terms of sort of sentiment and expectations, this is the outlook for December. And what we can see here is a month ago, there was a strong expectation that we were going to see 25 or 50 basis points worth of cuts in the remaining 3 meetings. That overwhelmingly now has shifted towards the idea we're going to see 3 cuts in 3 meetings, or 75 basis points worth of cuts in the remaining 3 meetings of this year. So that's where we stand at the moment. And so the question mark here is like, where are we going to see movement? Are we going to see movement in the direction of additional rate cuts? There's quite significant pricing already, right? Markets are now expecting 3 of 3. So then it's a case of, are we going to see something that points towards are we going to see a 50 basis point cut this time around? And then markets expect 25 and 25. That could move the needle. Are we going to point towards a faster pace for the rest of this year? Unlikely, because if we see a 25 basis point cut, they're not then going to be like, oh, but we're going to enact a 50 next time. That just doesn't make sense. If they're going to enact a 50, do it now, right? And then other than that, it could be a case of laying the foundations for rate cuts at each of the meetings, each of the different meetings next year, or maybe not 1 in 2, maybe 1 in 1, something like that. And part of it is going to come down to the projection. So we get projections, we get a dot plot from the Federal Reserve. And so this outlines exactly where they think inflation's going, where they think growth is going, and where they think interest rates are going. So that could be key. If we're talking about them not really having that much maneuver in terms of looking more dovish than markets currently expect for the rest of 2025, there is room for maneuver when it comes to matching or topping estimates for next year. So how do we see the dot plot shifting? That could see significant potential market movements coming into play. Now, in terms of market movements, let's just jump on some charts and see exactly how things are shaping up at the moment, how things could play out. First and foremost, this is the chart for gold from a long-term perspective. Let's go into the weekly time frame. There we go. I've got the Bollinger on here at the moment. Let's just get that off. So that's the long-term trend, right? This is monthly time frame even. So this is no doubt a good market. Do you know what I mean? Like, we're looking for trends, and we've got one here. So no doubt, our clients are very keen to trade this. Everyone seems to be jumping on the gold bandwagon. There's plenty of reasons for it. I don't have to go into all of them right now. But certainly, in many of my videos, I have explained many of the different reasons behind it. What is relevant for this week is the fact that one of the major reasons behind it is that gold tends to do well when interest rates are cut and when QE is enacted, things like that, right? So we're coming into a rate decision and gold prices are punching up through resistance here and coming into the highest level since last Tuesday. Now, notably, we've seen this rally, we've seen this pause, we've seen an ABC style retracement, which is part of Elliott wave theory. But I find that within trending markets, often that's how the pullbacks come into fruition. you sort of see a low, and then you see another low, and then that's the ultimate low. And then once you break up through that prior resistance, that's the signal that you're done with the sell-off. Often you might pull back once again into a higher low and then punch higher. So if you look at price action at the moment, we've seen sort of higher highs, higher lows, then low, lower high, lower low. That next rally came flat essentially into the prior swing high. So that means the creation of lower highs is no longer in play. The next sell-off, therefore, is likely to be a retracement before the bulls come back into play. That's what's happened. We've come into the 61.8 fib. We've rallied up through resistance now. So now we've punched through that high of 65.56, and the next level that we're going to be looking at is the record high, which is 36.74. So for me, I think there's a good chance that what we've seen here is sort of an inverse head and shoulders formation, essentially. So lower low, higher low, and the neckline is just essentially two flatlining, a flatlining neck with the head in the middle, and now we've broken through that right shoulder. So to me, things are looking bullish once again, and so really, as long as we don't break the 36.26 level, then near-term pullbacks are likely to be gobbled up by the bulls, in my opinion. And you know, the question mark here is, I guess, you know, how is this meeting going to impact things? So if we want to see exactly how things are shaping up in terms of compared to market expectations, we'll put on the US 2-year. Remember, the 2-year, the 1-year, the short-term yields are highly correlated to market expectations around the Federal Reserve. So if we look at this, we have to think about whether we want it in this format or inverted. On this occasion, we want to invert it. The reason being that when we see interest rates cut, so that means this moving lower, it should benefit gold. So in which case, let's just flip it, knowing that, and say, okay, how is this playing out recently? So you can see there very closely that correlation has been playing out very well. That means if this meeting sees interest rate cuts coming into fruition, people feeling confident that they're going to continue to cut rates, and that drives down the 2-year, then that should be bullish and positive for gold. Certainly we've been sort of consolidating, much like we have in terms of gold prices. But if we were to see things rolling over once again, which is exactly what's happening at the moment, if I invert it, you can see it's starting to roll over. If we continue that, that's a potential precursor to a break higher and a bullish phase coming into play for gold. So dovish sentiment, dovish tones, rate cuts, that's all good news for gold, and price action certainly acting in that way. In terms of the US dollar, I've once again overlaid it with the 2-year. This is the 4-hour chart, so you can see here that, you know, you will see periods where maybe like it sells off here, but it holds up well there. You know, you will see periods where a move in one doesn't necessarily sort of fall in line with the narrative that would benefit the other, or vice versa. On this occasion, we are not inverted. So essentially it means that rate cuts are bad for the US dollar, and a sort of hawkish stance from the Federal Reserve is positive for the US dollar. So yields sort of moving lower, the US dollar moving lower. If we look in terms of the wider trajectory and just sort of take this 2-year out, the daily time frame, you can see here we've got this descending trend line coming into play more recently, and it looks like we're sort of gradually rolling over. So we have that sort of bearish outlook, the long-term trend in play. If I'm looking at sort of more recent swing highs, then I'll be sort of tagging, not that. I'm just going to tag a few of these swing highs and just show you. So what I like to see is, like, do we break the prior swing low, right? So we've created this low. That means we can tag that next swing high. We break, we marginally get below that low. So that means that next one is your next swing high. We break lower. So this wouldn't be, we break lower. Yep. Then we rally up. So that is potentially you're going to be your swing high. But it's a potential because we've broken, but we haven't broken through the prior low. The caveat is always that you can go A, B, C and come into a deeper retracement of that. And certainly you have got this, you have got the case that this is relatively shallow highs that you've got here. So do we come into that trendline resistance? Maybe not, but certainly if we see the rate cut, we see dovish stance coming out, then it does benefit those looking for further weakness for the US dollar. But, you would say, look at price action of late. It's not massively bearish, It's been moving lower, but it's very slow downward trajectory of late. Do we see that ramping up? Really, it comes down to exactly how this meeting shapes up. But I think there's a good chance that we do, considering the way that this has been sort of in these sort of wide swings. Do we see a bit of a near-term rise into this meeting? Not sure. I don't know whether this is just going to be a case of sort of sell the rumor by the fact when it comes to the US dollar or not. But certainly keep an eye out for that 2-year. Keep an eye out for whether we can break out from this sort of zone, because we have sort of been trundling along. We're now at least back into trendline resistance. So that provides the potential basis for us to break through towards the downside and continue this bearish trend. And certainly we'll have greater confidence with a breakthrough that 97.1 support level for the US dollar. And finally, looking at the Nasdaq, this has been a big outperformer of late. And today it's Tesla. Tesla been doing very well, up 7%. I think $1 billion worth of shares for Elon Musk that he's bought, as if he doesn't have enough of them. But anyway, he's a hungry man. And so what we're seeing is just continued record highs coming into play here, really. I've overlaid the 2-year once again just to show you it doesn't always play out in the way that expectations around rates are a massive driver in terms of equities. They're not always, quite frankly. You can see here that like there's periods where we're talking it inverse. We're seeing periods where it's positive correlation. So the ability to be able to overlay these and see what phase you're in, where the markets really care or not about the rate cuts. Maybe they're worried about, maybe a rate cut also means a recession. If that's the case, that's not necessarily great for equity markets. Nonetheless, I don't think that is the case. We're seeing weakness in terms of the jobs market, but I don't think we're necessarily pointing towards a recession or anything that's really sort of detrimental in terms of US businesses at the moment. So the tech stock certainly leading the Nasdaq higher at the moment. If we're seeing this, I've got this inverted at the moment. So if you see that's the real yields, which means that if we see weaker yields, then we're seeing strength in terms of equity. So right now, markets are in a mood where the idea of interest rate cuts is benefiting stocks, in particular in the tech sector. And therefore, if we see rate cuts coming into fruition, which by and large looks like it's near enough nailed on, that should be good for the likes of the Nasdaq. Let's just see in terms of trend line support. If we see a pullback, that is a lovely one. So we've run away a little bit from here. I think the Bollinger Band's probably going to be quite useful from here. Let's just get that up. Bollinger Bands. There we go. And let's see exactly how that's shaping up. So let's go on to maybe the 4-hour. So we're sort of pushing up. We've managed to sort of extend to the point where we've closed up above that Bollinger Band. Sometimes when that happens, we do see this sort of phase where it stays above the Bollinger Band. But we're definitely sort of pretty well stretched on this front. So do we see a pullback back towards this ascending trend line for this chart? Possibly. Certainly things very strong at the moment. Individual names really helping things along. But you do see a lot of the time, if you're looking in this chart in particular, you see these phases where you see that surge well away from that trend line, and then we're sort of seeing it come back in towards it, back in. So I wouldn't be surprised to see either sideways consolidation to let things catch up, or we see a bit of a pullback. Do I think that we're on this occasion just going to continue to fly upwards? Not necessarily, but then we're not that far away from this rate decision. So if we do see this rate cut, it comes out really dovish, everyone can say, yippee, we're in for a period of lower rates and the economy is going to suddenly turn up because of all these trade deals that Donald Trump's made. And then we'll think, great, best case scenario where we've got rates being cut at the time that the economy is strengthening in a meaningful manner. That's certainly a view of many. But equity's holding up very well. If we see a pullback, by that point, we'll be unlikely to break through because to take a little bit of time. We'd have trendline support and this horizontal support, essentially, is what I'm trying to say here. So as long as we don't break the 240.59 and this ascending trendline, then near-term pullbacks, in my mind, are likely to be fleeting in nature and bought up. Because ultimately, buy the dip is the name of the game. Everyone's been doing it. And irrespective of the question marks that have been emerging in the jobs market, people don't really care. and they continue to buy the dip, and that's why this chart looks so good. So I hope that's been useful. Half an hour on the clock. Yeah, a massive week for markets, and the Federal Reserve is key to that, is the centerpiece of it. Will we see major shifts in terms of expectations from around the Fed in the future? Maybe not. But keep an eye out on the 2-year, because the 2-year yield might move irrespective of where we see shifts in expectation, just off the back of having a rate cut, and therefore we start getting into a position where that again benefits the likes of gold, benefits the likes of equities, potentially drives the US dollar weaker. Or is this a sell the rumor, buy the fat, buy the rumor, sell the fat, depending on the market you're looking at? So big week and big event coming up on Wednesday. I hope it's been useful. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Make sure to like, subscribe, and all that good stuff. Thanks a lot, guys.